Hey, what's going on, everyone? Mark here. Thanks for joining the channel and thanks for being here with us today to talk about your credit score, what it means, how it's made up, and how to improve it. Here on this channel, we talk about financial education, real estate investing, and other life skills. Thanks again for tuning in. Okay, let's get right to it. Credit score. First, before we move into improving your credit score, I think we need to understand what makes up your credit score, okay? And so the first thing I'll do to everyone or for everyone is advise them to go out and get, a free credit score app or service such as Credit Karma. I don't get paid for recommending them. And go ahead and sign up for free. You can check it multiple times a week. It doesn't hurt your credit. It's not a hard inquiry. But it gives you a good rough idea of things that are going into it. It also gives you a good idea of how to check for, some anomalies and some different things that were some mistakes that were on there. But diving right into it, like I said, first we need to understand what makes up your credit score, okay? And so there are 5 things primarily that make up your credit score. First thing, and we're going to go ahead and go through these in order of importance, okay? So the first thing that makes up your credit score, the most important part, it represents about 35% of your total score, is going to be your payment history, okay? And so another fun fact for you here is to get a good credit score, to get into, the 720, 740, approaching 800 type credit score, you're going to need 99% or better on-time payment history, okay? And so payment history is exactly what it sounds like. It's the amount of payments that you've made on time, divided by the entire amount of payments that you've made. And that's going to give you your on-time payment history, okay? And again, you want 99% or better. So if you've made 99 on-time payments out of 100, then you will have a 99% payment on-time ratio. Ideally, you want that to be 100%, but you can still get away with about 99% or above to get a good credit score, okay? And again, that represents about 35%. It's a high impact on your overall credit score, okay? The second thing that impacts your credit score is your overall credit utilization rate. And all that means is out of all the available credit that you have together, you combine it all in one. Let's say you have 5 credit cards, all with $10,000 limits, and you don't have any other credit available to you, okay? So you're going to have a $50,000 credit limit overall. The credit utilization rate is the percentage of which you use out of that $50,000. So let's say you have $10,000 across all your credit cards. Essentially, your credit utilization rate at that point would be 20%. Again, it's just a division problem there. 10,000 divided by 50,000, you get 20%. Okay, and so the general rule of thumb here to stay in the positive area as far as impacting your score positively is stay at that at the minimum 30% utilization or below. We'd really like to see you somewhere in that 15, 20% or even lower than that. To get a really good score, to get that sought after 800 score, you're going to have 9% or lower credit utilization. And so this is another high impact area. It represents about 30% of your credit score. At the end of the day, if you're close to maxing out all of your available credit, then you're a little bit less risky. There's nowhere else to turn to, and you've maxed out all your available credit, and it sends up red flags, to the credit score police. So we'll talk about some tips and tricks on how to improve that in just a minute. But again, those are the 2 high impact areas that drastically affect your credit score on a day-to-day basis. And we'll talk about things we can do to improve those. The third thing that affects your credit score is the overall age of your credit score, okay? Or the overall age of your credit accounts. And so to be, to have a healthy, real good credit score, you want to aim for the average age being 7 years or more. I will tell you that that's a tough thing to do, especially for the younger viewers on here. Even myself being into my 30s and having credit accounts all the way back to being 18 years old, I still only have a credit average age of credit of about close to 7 years. So we'll talk about what that means as well. Although I will tell you, and I probably should have started off the video by saying, I have an 800 plus credit score across all reporting agencies. And that's why I'm making this video, is to help share with you tips and tricks on how to get a good credit score. I've had an 800 credit score for a long time now. and I've always had well in the upper 700s throughout my 20s, and I probably hit 800 late 20s, early 30s by the time some of those other things got up there. Age of credit represents about 15% of your credit score. We'll say it's about it's a moderate impact on your credit score. Again, I still have an 800, and I don't have that 7 years or more average age, but it does impact your credit score, especially if you start only having 1 or 2 years of average age account. The fourth thing that impacts your credit score is the amount of total accounts that you have, or the different types of accounts that you have. Okay, so there's different types of credit. There's car loans, installment loans, things like that. There's revolving credit, like a credit card. There's home equity line of credits. There's mortgages, student loans. Obviously, we're going to make a lot of videos on student loans on this channel. But at the end of the day, creditors like to see that you've been able to use different types of credit, over long periods of time responsibly. Okay, so that's why it impacts your score a little bit. They definitely want to see that you've had an abundance of credit over the years. So you want to aim for 10, 11 plus accounts to really get into that good area of increasing your credit score. At the end of the day, this area represents about 10% of your credit score. So it's a low impact in the grand scheme of things. However, it does look good to have multiple different types of accounts. Now we'll go into tips and tricks on that as well, but I do want to caution people, I am not advocating that you go open car loans or heavy equipment loans, or get additional HELOCs and things like that, just to improve this portion of your credit card. There's simpler things that you can do that have low impact, okay? The fifth and final impact on your credit score is going to be hard inquiries, hard checks, credit checks. You've probably heard it called a bunch of different things, but these aren't to be confused with, going out to a free service and, like a Credit Karma, like I said, and just checking your credit score. These are when you apply for a mortgage or an auto loan or a new credit card. They reach out to the credit bureaus and they go ahead and check your credit score. And when they do that, it's called a hard inquiry. Okay, and what that signals is you're looking for credit. It could signal for somebody that's desperate to hang on to their house to get new credit to continue going in the hole. It signals a lot of different things, but at the end of the day, it does impact your credit score. It represents the final 10% of your credit score roughly on average. The good news is, two hard inquiries on your report at any one time is not a big deal, and most of the time they take into consideration, say you're going to check your mortgage rates or mortgage broker. If you have a couple hard inquiries all within the same weeks or even within the same 30 days, that has minimal to very little impact on your credit score. The other positive news is, after about 3 months of getting a hard inquiry, it really starts to diminish the impact on on the score. So over time, those fall off, and after 2 years, they totally fall off your credit score in general. So those are the 5 things, again, that make up your credit score. Just a quick recap: payment history makes up about 35%, and you want to go ahead and stay at 99% paid on time or better. Credit utilization represents another 30%, and you want to stay at 30% or lower credit utilization rate at the most. Okay, so you really want to shoot for 15% or lower, in my opinion. However, 30% or lower, will still have a good effect on your credit score. The third thing that impacts your credit score, just recapping again, is the average age of your credit accounts. That's about a 15% moderate impact on your credit score, and the average age that you want to shoot for to be in really good shape is about 7+ years. The fourth thing, as we move through the things that impact your credit score here, is going to be the different types of accounts or total accounts that you have. You want to shoot for 11+, if possible, over the time. Now, they don't all have to be active necessarily. However, 11+ over the long run is a good spot to be in. That represents about 10%. It's a low impact on your score. And then finally, the hard inquiries, which sometimes there's not much you can do about anyway. But that represents about 10%. And you want to try to stay, if you're looking for maximum credit score, you're going out searching for loans, things like that, you want to have 2 or less hard inquiries on your credit in the last 2 years, roughly. So next, we'll move into how to positively affect and improve your credit score, which I know you guys are all waiting for. Okay, so jumping into improving your credit score. So we're going to go through a couple quick tips and tricks and hacks, whatever you want to call them, things that I've done, things that other people have done to improve their credit score. We'll just kind of start from the top. You'll see a common theme here. And, just again, I'm not a, financial planner or anything else like that. I'm offering my opinion, things I've done, things that I've seen that have worked, and I'm sharing with you information that hopefully you get a lot of value out of. And if you do, please like below, consider subscribing to this channel, and share with a friend if you could. Jumping right into it, payment history. Okay, we know that that's the biggest impact on your credit score. There's a couple things that you can do to improve your payment history if that's one of the low areas on your credit score, okay? And it can have the most significant impact on your entire score. The first thing you can do is get in a situation where you're making more payments more frequently, okay? And what I mean by that is, let's say you open up a new credit card, okay? Now all of a sudden you have 12 new payments a year on top of what you were already having. So quickly you can go ahead and add up the amount of payments, which then the weighted average on paying on time quickly increases. Okay, so just give you a quick example. If you had just doing rough math again here. If you had let's say 10 payments a year, right? For one reason or another, your payments. Let's just do 12. You had 12 payments. It's like 8.4%, something like that. For each payment. So if you miss one and you only had one credit card and that's your only account and you miss one payment for the first year, and this is your first year of credit reporting, you are now going to have a 91 point, let's call it 6%, somewhere in there, type payment history. Okay, that's terrible. It's very, very, very bad. Your credit score is going to be very, very low. Okay, now let's say that overall you had enough accounts where you had to make 100 payments, okay, and you still missed that one payment on that one credit card. Now you've made 99 on-time payments out of 100. You'd have a 99% payment ratio, okay, or on-time payment percentage. So the one thing that you can do to increase this number and improve your credit score on payment history is to have more accounts, which is going to have more payments and obviously make them on time. Now, if you're someone that isn't responsible with money yet, or you don't trust yourself, or you know you're going to spend money on that credit card, please, by no means am I saying go get a new credit card just to improve this portion of it. The other option is you wait through time. Through time, continuing to make on-time payments is going to improve your payment history, okay? Your on-time payment percentage. Obviously, the longer you go making positive on-time payments, the better that percentage is going to get. Okay, so those are kind of the two options to improve that. Again, it's the biggest impact on your credit score. I cannot stress it enough that you need to pay your credit accounts on time. Now, typically there's grace period too. Just another little tip for you guys. Most of the time they don't report until after 30 days of being late. In some cases, even more. However, I'm not giving you advice on that. I want to let you know that even if you're a week or two behind on that, it still makes sense to call immediately and get that bill paid. Most likely it won't report to your credit agency. And in the event that you call them and you ask them the question, was this already reported? If it was in agreement for this payment, can you please, not report it? There's things like that where you can negotiate with these creditors, okay? So just keep that in the back of your head. I'd like to move on to the next thing here. The next thing is credit utilization rate. We're going to follow the same theme. The biggest thing that you can do to increase your credit utilization rate, there's actually two things, okay? So the first thing is going to be go to your existing accounts that you have right now. So for instance, if you have some multiple credit cards that are out there, I just did this yesterday, so I'm taking my own advice here. You go to these accounts. Let's say I had a credit card with a bank that I've had for, let's say, 10 years, and I have a $10,000 limit. Most of the time you can do this right online. Other times the Home Depot card through Citibank that I'm using, you have to actually call and request it in person, or request it over the phone, but most of the time they're online with the big banks. You go in there, you update your income, and you request a credit increase. This morning I did it, and I got a $5,000 increase on a $10,000 card, and that increased my overall limit on that one card to $15,000. Okay, so if I had $5,000 yesterday on that card and a $10,000 limit, I would have had a 50% credit utilization rate, which is high. Okay, the second that I got that $5,000 credit limit increase on that credit card, Now I have a 33% credit utilization rate, okay, and which is much, much better. My score instantly increased multiple points if I would have had that high utilization rate, okay? So that's the first thing that you can easily do. Now, if you don't have a bunch of credit cards or you don't have credit increases that you can get on a line of credits, or something like that, then the next thing that I would recommend doing, or the next advice that I've taken myself, is open up another credit account. Okay, so you open up another credit account for 2,000 or 5,000 or 10,000, depending on what you can get approved for on your credit card. That automatically increases the overall credit that you have available to you. Okay, so same scenario with that card. Say I have $50,000 in all credit cards that are available to me in all credit, and I open up a new $10,000 card. Now all of a sudden I have $60,000. So whatever my credit that I was using was, my credit utilization percentage has now decreased and hopefully got me below that 30% threshold that I mentioned earlier in the video, okay? So those are the two things that you can do. Again, ask for credit increases on credit cards, line of credits, and other accounts like that. If that's not an option for you, then opening up new lines of credit with decent limits will certainly help as well. Again, going back to what I said earlier, if you don't trust yourself with credit cards and you don't trust yourself with credit and you can't use them responsibly, I am by no means suggesting that you should go out and get more credit. However, what I am suggesting is that you subscribe down below and you keep watching this video, or you keep watching this channel, because hopefully this is going to teach you, financial literacy and education and make you confident of your finances, okay? So moving on to the next thing, age of accounts. There's very little things that you can do here. I'll be quick on this tip. What I would recommend is don't close old accounts. Like I said earlier, I have some old accounts from when I was 18 years old. That's the only reason why my credit score is up at, or why my average age of credit is 7 years, right? Or 6.5 years, 7 years, right around there. So that helps significantly, because as you age and as you go through life, you get new cars and they come on, and that starts as 1 month old, right? The first month you have that car, or mortgages, or every time you move or close out a car loan or a home loan or anything else like that, you're starting new credit and it hurts that average age. So you need some of those old, accounts that are just kind of legacy accounts that you've had forever. For me, it's a couple from the bank I originally started banking with as a kid, and I've left them open, and I've continued to build up their credit limit, and they help me out on my average age. I don't even use some of them anymore, but they're still open, again, to help out with my credit score. These are things that people don't always teach you that are important. So when you get that card from Macy's, or you get that card from Best Buy, or wherever, when you're in college and you're 21 years old, and now you're 30 and they're threatening to close it if you don't use it, I recommend go use it. Go put $5 on it. Go get, a dollar candy bar. It doesn't really matter what you put on it. Pay it off the next month and they'll leave you alone for the next year or 2 years. Continue to keep that open. It will hurt significantly. The next thing would be the type of accounts or total accounts. Staying kind of consistent with what I've been saying here, opening up a few additional accounts can certainly help you in this area as well. It'll get that number of accounts up. The other part of this is this just naturally happens through life for most people, not everyone, but most. You end up with a car loan, you end up with a mortgage, you end up with multiple credit cards, different other types of loans as well, and then obviously student loans, which end up getting reported as well. So not that I'm advocating to go get any of those things. Matter of fact, we're going to have tons of videos on student loans, tons of videos on automobiles, tons of videos on, your mortgages, refinancing, HELOCs, lines of credits, all that kind of good stuff. I'm just saying naturally through life, most people incur these things. So I wouldn't really sweat the type of accounts or overall number of accounts. Again, it only impacts about 10%. However, just utilizing credit intelligently over the long term will help this. The last part that affects your credit score is the hard inquiries. And we discussed that a little bit earlier. What I will tell you on here is I'm not telling you to just not worry about it. However, again, it only impacts about 10% of your score. It's not worth really getting upset about. What I will say, though, is don't be dumb about it. Don't just go get, hard inquiries day after day after day just to check out if you can get approved for the next best, greatest credit card all the time and all that kind of stuff, and just use it, willy-nilly. If you're going to do that kind of thing, you're going to pick up 2-3 new credit cards, or you need to to get a mortgage or a home loan, make sure you do all of those in one month if you can. One week, 1 month, all in a short period of time. Then they know you're out there looking for this credit, this car loan or this automobile loan, and they kind of forgive you a little bit on that. Again, they also will come off your credit score or your credit report at the same time, which will have a dramatic increase in your credit score, depending on how many you had there. But going back to what I said, it only represents about 10%, and getting that credit utilization rate down, getting the payment history back up to 99+% is certainly more valuable and more important than the impact that the hard inquiries have on you. If you guys like this video and you're interested in seeing more, please hit the like button down below again. Consider subscribing to this channel, share with a friend. I intend on putting out a whole bunch more videos in regards to financial education, real estate, overall life skills, and I hope that you all enjoyed this video, and I'll see you again next time.